We're going to go to Jim Stenning. Time for a check on the bond markets. Not too much reaction to this week's RBA rate rise. We'll chat about that. Jim, welcome to the studio first, of course. But I also wanted to ask you about this issue of the liquidity guidelines being proposed by APRA, because this is something that a lot of the big banks, or particularly yesterday with Westpac reporting, they've been talking about that. Changes to the liquidity requirements, really in response to the global crisis. What impact do you see that having? These changes?
Well, it's interesting. It's arguably a little bit disruptive. I suppose you can look at it from what impact it'll have on the market or what impact it'll have on the banks. But I guess what's really being proposed is, excuse me, trying to implement global best practice. You know, what they're sort of focusing on is through the crisis, assets that were described as liquid proved not to be so. And so, you know, taking it back to first principles, looking at zero risk assets for liquidity, but also overlaying some stress tests that can demonstrate to investors and to the regulator that that these ADIs are on top of their liquidity requirements. So I think it's a really important development in terms of moving ahead and the removal of the government guarantee on the deposit markets, and overall, if you like, confidence in from retail investors in the banking system. There
are a few concerns, of course, and the banks are quite concerned, obviously, but there seems to be a worry about the definition of liquidity at this stage. What kind of assets qualify then?
Well, what qualify at the moment under APS 210 are assets like cash, bank bills and NCDs issued by investment grade issuers or banks, term deposit or deposits that can be liquidated in 24 hours, and any repo eligible assets with the Reserve Bank. So what's proposed, the fundamental change to that is more a weighting towards government issued assets, so government bonds and semi-government bonds.
And in that case, so there's been a suggestion then that the banks lose a source of funds, and that could mean for equity investors maybe dividends not increasing in the next couple of years, for example.
Yeah, well, it's interesting how it'll play out. I mean, obviously the banks hold tens of billions of dollars worth of these assets, and a lot of them are issued by other banks. So yeah, I mean, obviously that source of funding for those entities needs to be replaced because they're actually funding the government rather than each other.
And specifically, what do you think is the concern of the banks? Because we had some comments yesterday from Westpac's Chief Financial Officer and even Mike Smith from ANZ last week, kind of with an approach of, you know, if it's not broke, don't fix it.
Yeah, well, I think one of the problems for the Australian banks is that they're sort of being tarred with this global regulator's brush. I mean, obviously, you know, we didn't experience the disasters that the UK banks and the US banks have, and so, you know, arguably we do have an efficient, you know, well managed system. I suppose it's trying to fit in with those global changes to be able to participate in the global market. But yeah, I mean, if you have to replace, you know, higher yielding assets with lower yielding assets, that has implications for your net interest margin. So yeah, it wouldn't be a positive to the bottom line for the ADIs.
And are there enough bonds in Australia to actually satisfy those new requirements?
Not at the moment, no.
Yeah, right.
Look, they're not. I mean, you know, and I think this is something that APRA has highlighted in their discussion paper, and globally other regulators have sort of allowed, you know, foreign issued bonds, so treasuries and gilts may apply, supranationals, that's certainly the case in the UK. But I think what's proposed under the new 210 is that certain other assets will apply, but also it's something that will be phased in over time.
Could it create a credit crunch, as Phil Coffey from Westpac said yesterday?
Well, I'm not certain that it can. I mean, there are various things that can happen. I mean, one of the things that the side effects of implementing this new regime might be that the banks actually, you know, their credit quality is enhanced over time, so they might actually be upgraded. As far as the bank's propensity to lend, well, I suppose that's really a function of the broader economy and how well that's managed.
And just on the issue of RBA rate rises, which I promised we'd chat about as well, do you think the decision to raise rates for a second month was a good one, and do you expect rate rises from here, and how quickly? Well, we all expect rate rises, but how quickly?
Well, I think it just comes back to this decision to remove the emergency settings, and so I suppose if you've made that decision, and I think we'll only know whether that's the right one or not in 6 months' time. So yeah, they have to make these adjustments, and so I'd expect every meeting for there to be another adjustment until we're sort of back to normal levels.
Jim, thank you very much for your time. There's always more that we can go through, but we're out of time for today. Thank you, Jim.
Thanks,
That's Jim Stenning from